If that does go into effect, all of a sudden, if you're doing any sort of real estate with long-term projections, or if you are doing multifamily real estate that is, its valuations are based off cap rates that is expecting some kind of growth, this will absolutely affect your upside potential on that. What's going on, guys? Welcome to today's episode of the Collecting Keys podcast. Today is Wednesday. This is the off-market operator update. Start calling the show that. And if you're thinking...
We copyrighted that, right?
Yeah, we did. If you're thinking that sounds like another real estate operator show, Cole Johnson, it's because I saw that he abandoned it on all of his socials. So, Cole, I'm stealing it from you. If you have an issue with that, you can go ahead and send me a DM on Instagram at Mike_invests. But if this is your first time here, this is the show to teach you to make massive income, not just passive income with your real estate investing business. And our new goal is to help 2,000 real estate investors build 7-figure businesses. So if you're interested in growing or scaling a business, this show is for you. Welcome. And on these Wednesday shows, we do a deep dive into kind of what is going on in the world of off-market real estate, specifically real estate investing, and people doing it at a high caliber level. And so we dive into news, things that you should probably know, and just overall market conditions if you're a real estate investor trying to scale a business. And so I'm Mike DeHaan here with my co-host Dan Austin and Dylan Cook.
Hey-o.
And Dylan, what do you have for us today? Because we have a handful of things to dive into.
Yeah, no, we got a couple of things to talk about today, so I'm looking forward to it. But the first one, as we kind of teased last week, is like the most successful operators I know are very data-driven. Right. Mm-hmm. And they let those decisions, they let the data decide their decisions and vice versa. Mm-hmm. And I think what Peter Drucker is the famous guy that says what gets measured gets managed. So I wanted to kind of dive into KPIs, specifically what off-market people should be looking for. In my opinion, like cost per lead and cost per deal are probably the two most important. But also we can even get more granular of, you know, what marketing channels, how that changes it, your profit per deal, if that changes. Mm-hmm. So I'll let you guys kind of run away with it and how you guys are managing your team and what you guys are looking for across all your different markets.
Sure. And I'll say that becomes a KPI conversation. You know, if you think it sounds boring, don't turn it off. There's a couple of different reasons to be aware of your KPIs. So you can actually make decisions with your business in an analytical fashion, kind of like you teased to Dylan, not like an emotional fashion. But also, too, when you are getting pitched things on social media or by marketing companies or by coaches or by communities or by whatever else, if you know the basic fundamentals of what a successful real estate investment company looks like, okay, then you can actually know if they're full of shit or not pretty easily.
Totally.
And if you've listened to the show over the past, I don't know, a couple of years we've been doing this, you might hear when Dan and I get fired up when we had a guest on the show previously and we would dive into some of their numbers and they would have numbers that were on track because all of a sudden we would know that they were verified. Versus we get some of the other people that come on and their cost per lead is crazy low. Their, lead gen per deal is just off base from what it should be. You know, they're full of shit because all the people that we have verified are good operators. We kind of have the same numbers, or at least we're in like the same ballpark, right? Totally. You know, and even you, Dylan, versus, where we are, like we have vastly different scales of businesses in terms of like our team size and everything else, but our costs per deal are relatively similar. Like, it's not like, one of us is 25% of the other one, because ultimately it doesn't fundamentally make sense. Every business has market standards. And if anyone is outside the market standards, it means they're either lying to you or they're not sharing exactly what they're doing.
Or they're doing something illegal.
They're doing something illegal.
Seriously. Right? Yeah. One thing I've noticed too is like, just to preface everything like you're doing, Mike, is like, if things don't sound right, they probably aren't. I remember when we were starting out and you'd be looking at stuff online or talking to other people and you're like, I just don't know how they're doing that much more better. Like, how are they doing that? And in reality, they weren't. And it was just talk and it was fluff. And then you get into business and you start realizing what those benchmarks look like. You talk to other solid operators that you trust and you start getting that weather vane for what good looks like. And then you stop envying or thinking that other people are doing that much better, because you can either say they're lying and it's all bullshit, or they're just, actually doing well. It's just not as well as you think it is, because, you only hear the wins a lot of times when it's external.
And if you're in the beginning of all that too, like that could bode, your confidence pretty well, because you could get down on yourself pretty quickly. Like,
Mhm.
why is my cost per deal
Totally.
not $1,000 or $1,500? What am I doing wrong? In reality, no one that's doing this at any type of scale. Right.
Yeah.
Totally.
So,
And I think that the thing is you don't actually know what your true numbers are for your business, honestly, until you've been operating for like a year or longer,
Yeah.
and you've spent, I don't know, I would say $100,000 total on your business. Then you,
probably.
like, over the course of a year or longer than that, then you can reflect back and see what your real numbers are, because it's kind of like when you're doing cold calling, right? You know that if you cold call enough people, you will eventually get a deal. Statistically, you could get a deal on your first ever phone call. Statistically, it could take your 50,000th phone call, right? At like the most extreme other way. And somewhere in the middle there, you're going to get a deal, 2 deals, whatever. And the thing that you need to figure out is what your average is after you get not 1 deal, but 5, 10, 15, 20 over that period of time to be able to get your actual metrics. And so when it comes to an off-market business, I think there's really, I would say the 2 largest ones that I care about the most are your cost per deal and your close rate on your contracts that you get. A lot of other ones, cost per lead, offers per deal, those sort of things, they'll vary a lot depending on kind of the lead generation that you're doing and how good your sales team is, how tough your market is, things like that. But cost per deal and your close rate seem to be pretty universal, what those look like across everybody. And so it'll go up as your business kind of grows and you tend to have more inefficiencies. And so for us, and for like a lot of like the more scaled operators I've seen, the typical cost per deal is typically between 4,000 to 4,500 right now. For people that are single person operators or like small teams, like less than 3 or 4 people, they seem to be in that like 3,000 to 4,000 range, kind of depending on the market. And then across the board, the typical close rate of an aggressive company that is taking down a lot of appropriate shots is typically around 70%. So that means that 70% of the deals that they're signing are actually closing. And anyone that is significantly below that, it means they're probably not making very good offers. Anyone that's significantly above that, if someone tells you that they're doing like a huge amount of volume and they're significantly above that, then they're probably full of shit. If somebody's doing a little bit of volume, like 1 or 2 deals a month, and they're significantly below that significantly above that 70%, then they're probably not taking as many shots as they should.
Or they're a person that just closes on everything.
Or the person that closes on everything.
If you close on everything, as in you will not drop a contract, and if you can't wholesale it, you'll still shake it down and flip it, which there are operators out there, which is fine.
Totally.
But some people will do it at all costs, even if that means they lose money. And so then that skews your close rate, because you have 100% close rate. Technically, right? Sometimes too, in that close rate, why people are like, well, why are you dropping contracts? Some of it you can't deal with. Like, there's nothing you can do, right? There's title issues that you just can't overcome. Or you get a property under contract, and lo and behold, the guy you signed the contract with doesn't own it. Shit like that happens in this business. So naturally, you're going to fall in that 70 to 80%.
Exactly. Or, I mean, property's in worse condition than they tell you, right? Very, very common. Or something happens over the course of the transaction. Actually, I made a post recently. I actually shared it from somebody. I can't remember who I shared it from, talking about if you're dropping like the price or renegotiating right before closing, your dirtbag.
Oh, yeah.
And somebody here in Spokane actually messaged me, and they said, I actually did that recently. But the reason was that there was a tenant in the property who completely trashed it the day before closing.
Yeah, that's out of your control.
That's out of your control. That's valid. And so
and why you have final walkthroughs too.
Why you exactly. Yeah.
Exactly.
And like there's always conditions to things, or like, honestly, sometimes if you're trying to wholesale, you can't find a buyer, and if you're in your due diligence period and you need to drop the deal because of that, that's part of the game. Like, it sucks. You should minimize that as much as possible. But that is something that happens if you're doing enough business.
I think with that though, it's just set the expectations right with the seller. Don't, like, especially if it's like their primary residence and they're like, yeah, pack up your bags. We got this thing sold, and you have no intention on like closing it if you can't find a buyer. Like, that's when I think it gets a little on the shady side of the gray area.
Yeah, for sure.
Absolutely.
Going back to the KPIs, like, I want to step back to the cost per lead discussion, because it's an important metric, but I don't want to overlook what Mike said about it's not as important as like cost per deal. And the reason why Mike said that is because cost per lead is going to vary between lead source And people get caught up, and you could very easily, if you're looking at it that way, you're like, my cost per lead on cold calling is vastly lower than my cost per lead on direct mail. Direct mail is a higher cost lead source. However, your cost per deal may be different on the back end of that thing. And that's what matters, because if it takes 100 cold call leads to get one deal versus it takes, 20 direct mail leads to get one deal, your cost per deal will not actually vary as much between the two lead sources, because you're having to spend as much, $20 times 100 versus whatever that math works out on a lower number for direct mail leads. So it's important, I think, to look at that though, because you very well might say, hey, I need to get some leads in here. So what is my lowest cost per lead? And you might think, why does that matter? Well, when you're first starting out, leads matter. Talking to people matters, and helping maybe a new person on your staff, if you're hiring, get good swings. You don't want to be spending a ton of money on mail just for them to throw it down the drain. So that's, one use case for that. But the cost per lead is a great metric to monitor. But remember, that's at the top of your funnel. And ultimately, you want to know how much money you need to spend at the macro level to get a deal. So if you're only cold calling, who cares what your cost per lead is, right? What is your cost per deal? If it's $3,000, $4,000, you just need to know you need to ramp up your cold calling to get to that level. To get 2 deals, to get 3 deals. And you might get a little bit better over time. So your cost per deal, instead of going to 4,000, might be 3,800. So you're saving a little bit of money because you're getting more efficient at it. But really, that's why we're looking at the back end of those metrics, to understand how much money you need to put into the top end of your marketing machine on the back end to close deals.
Exactly. Yeah. And
Go ahead.
I was gonna say, and if you are trying to figure out what that number is for you, or what a realistic expectation is look at people that have businesses that are operating and that you verify at scale, and just try to hit their numbers. And the perfect example of this is I did a little coaching call over the weekend with one of our scale members, and they're trying to figure out their first deal still. It turns out over the last several months, they have spent $12,000 total that they've spent on marketing over the last, I think it was like 6 months or so. And they're trying to figure out why, they've had a couple shots, they've missed out, things like that, but when that first deal is going to come. And it's like, well, you're realistically spending $2,000 a month on marketing. It's like, yeah, and you should have had one total, I guess, out of like that 12,000 that you've spent so far. But if you're just taking such small bites every single time, it's still going to take you a very, very long time to get that initial one across.
How much money did we spend on marketing to get our first deal?
30,000.
30,000 to
Which
get
is
our
about
first
what
deal.
I was too.
And Dylan, you're the same way. And that's coming from folks, I would say, I know us and I know Dylan, very skilled operators at this point. We've done a lot of deals, but you suck at first too. Like you just kind of suck.
Yeah. And that number seems to be pretty common too.
Direct mail specifically, that cost per lead or cost per deal will go down actually the more you do it, because you'll start cycling through those leads that take 3, 6, 9 months or maybe years to close. Right. And so if I closed the deal, I think last week, that was originated in 2022. Exactly. So how do you manage that? Right.
Yeah, exactly.
Yeah. And as you build up like that lead snowball, and you can keep sort of chipping away at it, it will bring down your total cost per deal as you just go over time, because the leads that you generate today very realistically could be a deal a year from now. But you still need to generate the lead today in order for that to be an opportunity.
You guys do anything with your cash conversion cycle that I hear other operators talk about? Basically,
I learned what that word was from a scale member at KeysCon this recently.
It's hitting on what you just referenced. Basically, if you spend $5,000 on direct mail, when do you expect to get that back? Is kind of the question to ask, and that's a very hard question to really answer in this business, especially with direct mail.
I would say that we don't do that just because we've been doing this business for so long now that we just have an abundance of stuff.
It's like a mental note as well. Yeah. We make mental notes of okay, we're going to have $500K going out for these projects. We need to spend this much money. We expect, 200 this month, 200, you kind of have a mental note. We don't forecast. We've tried in the past. But it's hugely important, because what happens is you get so excited about deals in front of you that you run out of money and you're like, oh crap, I can't market or I can't operate or something. And so what Mike and I learned early on, because we sucked at everything. And so we're we just need a lot of money. And so we started lining up lines of credits, HELOCs, cash in the bank. And we always personally had cash reserves so that we never starved the business, because neither of us were willing to put money into it, because we had those reserves and we just kind of mentally committed that stuff. So I think mentally committing cash and reserves and lines of credit is very important, and not going 100% max, because that's when we always see people get their asses kicked, because eventually you'll get your ass kicked on something. And if you're at 100% consumption of your capital reserves, you have no backup plan. And that's when I get calls from people like, hey, do you want to come in on this deal? We got to finish the rehab. We're looking for another 40 grand. It's like, fuck no, I don't want anything to do with that. And I've been asked that by other investors. And it's like, that's the wrong person to invest when they're halfway through a project and they need more money.
Exactly.
Totally. And the other thing, let's say you 1 to 3 deals a month, but you want to get to 5, and you know that your profit per deal is 20K, right?
Mm-hmm.
Well, you can almost reverse engineer how much marketing that you need to spend to try to get to that number, right? Which is why it's important to kind of know some of these things going in.
Yeah, the other one on that note too, Dylan, is the contract to close. Part of that cash conversion cycle is when you get a property under contract, how long does it take you to close? And like, you can also go back and look at when a deal comes into your pipeline, how long does it take to close? So maybe it's 66 days. So on average, if you're spending money in marketing, say I'm going to drop $5,000, it's going to drop this Friday. They're going to start calling me on Monday. From Monday, on average, it's going to take you 66 days to hit your average profit per deal, which might be 20K. So in 66 days, you'll get a 4X return on that marketing, at least 4X on that one deal.
Yeah. And that's why people tend to really struggle with cash flow in this business. They don't account for that, right? Exactly. They're not understanding that the stuff that they generate right now, even if it goes well, they're probably not going to get paid for several months.
And then what if they don't wholesale it? What if they decide to flip it?
Then if you're worried about getting paid right now, you should not be flipping anything.
Totally.
Yeah. That's so much truth to that. Holy cow.
Yeah. So, cool. All right, let's move on from KPIs and get into some news, because we actually have some pretty interesting things to go over. We've had several different legislation pieces pop up over the last little bit. Which one do you want to start with, Dylan?
The one I think you sent me today, which I'll read the headline for everybody, is this: Biden calls for rent control, which is obviously a kind of a clickbaity title.
Of course.
But as you dive into this, it's kind of like the who does this really apply to kind of a thing. And, is this, the other part of that is this another step creeping up, government taking another step into just being involved in the housing market? And what could this be as a precedent? But to set the stage, it's Biden announces his rent control plan to limit rent increases to 5% per year for corporate owners, with the corporate owner definition basically being 50 units or higher. And this only applies to existing housing stock, not stuff that is going to be or currently being built.
Yeah. And I wanted to talk about this one mostly because I've seen it being shared around social media by people that have like 8 properties and they're super freaking outraged by it. I don't know. Like to me, that's the same as when you have the person that's like so blindly Republican that they freak out about tax increases when like they work at $35,000 a year job. It's like, don't, it's not going to affect you. Don't worry about it. Right. And the thing is with this too, it's only temporary, right? They're saying they're going to only do this for 2 years, which is pretty.
So that's what they say, but the TSA is supposed to be temporary too.
Right. Exactly.
Hey, the TSA.
Now I get patted down. Don't touch me.
That's true.
Stop it. I got 3 points here that I wanted to share that I think these are my opinions on this. One is, this is a typical politician Hail Mary. Let me grab some votes. What are people saying on TikTok and Instagram and Reddit and all these social? We can't afford rent. We can't afford rent. And politicians on both sides of the aisle do this, right? It's like, what are the average people screaming about that aren't even the average people? They're just like the loud 1%. Like, we can't afford things, so let's get rent control. That'll get people to connect to this as a value add, as me being a value add. I do think that if this is a real policy and a real practice that goes into effect and becomes the normal, it does have trickle down effects. So you say 50 plus units, doesn't bother me, like, right? Like, I don't own big apartment buildings or whatever. However, when they can only raise their rent so far, guess what? You can't raise your rent any farther past that, because nobody's going to rent from you, right? So if the market's demanding an 8 or 10% rent increase, but all the big dogs in town can only do 5, there is some level of trickle down that I think it does actually slow rent growth. Again, I don't know that this policy itself will ever go into effect in that manner. I think it's kind of a bullshit, like Hail Mary type vote grab. And then the last thing is, it's a stupid solution. Rent control is the dumbest thing. Like, doesn't matter who you are, that's putting a Band-Aid on something, like on the wound that already happens, instead of stopping the wound from happening by implementing policy that actually helps reduce the cost of housing, which is what we want.
Yeah. Well, the problem is they're not regulating the expenses that increase for landlords. Like,
totally.
I mean,
everything is expensive, right?
Why do you
what
think rent went up?
happens?
Property taxes.
Property taxes
is a huge one.
Insurance is the other one.
Yeah.
Property tax and insurance alone. Every investor. I mean, we're all in Go Abundance. We hear people talking in the chats about like how their insurance company just dropped them completely, like just crazy shit.
Yeah, I mean, especially the last couple of years. I mean, my personal cash flow off like the handful of properties I own was like less than halved. Like it got just axed by the property tax increases. I had one property as a triplex that I owned. The property tax increase was like $6,000 a year, like $500 a month. It just took away the vast majority of the cash flow on this thing.
Yeah, totally. And then you have like local cities like we have here in Spokane where you have to get a license per unit, and you have to like get inspections, and then you have these repair costs that go up, which isn't all bad in itself, but it's an additional cost. Then if you you add all these regulations around it, and then you have macroeconomic regulations that affect like the cost of everything. And then you're like, oh, by the way, we're going to cap for you guys, we're going to cap what you can make, but all the other businesses, we don't really care. But for real estate, because that is something people, which I don't believe, or I do believe, like everybody in America should have the right to housing, but at what level, right? Like we're in like the first best country in the world, and we have people that can't afford housing. I do think that's a problem. However, the way to do that is not more regulation.
Dan, like to your point, one, there's more renters than there are homeowners. So like the political graphs makes sense to me, but the regulations they should be going for is like, how do you just provide more affordable housing? And rent control has proven over and over again it doesn't work. Like it is like they've tried this in history before. Like New York's had rent control since 1943. Like you said, it's a political grab to me, and I actually don't think this will even pass in the first place. But
I don't think so. It's kind of like the student loan things. It gets the Republicans all riled up. I can't believe they're going to pay off their student loans, but then there's a niche group that it may actually help. But it's, but all the, Biden's doing that, or the Democrats are doing that because they want to show they're doing things for the constituents. Unfortunately, politics has distilled down to like, what are you doing for me? So I vote for you kind of thing. At least that's the perception that I see in the media anyways.
Yeah, totally. Yeah. Either way, something to keep an eye on though. Because honestly, if that does go into effect, all of a sudden, if you're doing any sort of real estate with long-term projections, or if you are doing multifamily real estate that is its valuations are based off cap rates that is expecting some kind of growth, this will absolutely affect your upside potential on that. So
totally. And this ties into kind of our probably last and final topic for the day, but basically the government sponsored loans, Fannie Mae, Freddie Mac, basically this has been in the works since 2023 to take place probably in 2025. But if you are a multifamily investor or a big commercial investor, if you get a loan from them, you have now more stipulations for your tenants than you did previously, right? So this says that the Federal Housing Agency announces tenant protections that will be imposed on all multifamily properties with financing from GSEs, which is Fannie Mae and Freddie Mac. So new properties signed after February 28th, 2025. As of right now, government sponsored entities hold about 48% of all outstanding multifamily mortgages. But here's like the protections that they're saying. They're saying 30-day written notice in advance of any rent increase, 30-day written notice in advance of any lease expiration, and 5-day grace period for any late rent payments. Is what they're proposing. So for me, in my home market of Ohio, these are pretty much on par with what's already in place.
Yeah, that's way better than what we have in Washington.
Yeah.
Ours is 60-day rent increase, or 120 if you don't tell them before 60 days of lease expiration.
Yeah. So I guess would this overwrite state stuff?
I think isn't the rule that it always goes with a more stricter policy. So if your state is more strict, you'd follow state, but if it's not, you'd follow federal.
Yeah. Totally. I mean, what they're probably trying to get away from is some of these states where you can just like show up and just like grab people by the hair and like throw them out in the streets.
I mean, when you think about it, like there are some like reasonable things that are unreasonable, like things like policies, like it's kind of shitty to tell somebody 20 days before their lease is expired that their rent's going up, or, just not communicating it at all. And then all of a sudden they get a bill, which is in some states what it has been. Granted, I think that there has always been like an unwritten, like I guess, contract between tenants and landlords. Like the landlord's not going to try to screw over the tenant if this tenant doesn't screw over. Like if your lease is if your lease is coming up, right, as a renter, you kind of know, at least I did when I was a renter, I just always expected they're going to increase my rent.
Right.
So there was that there, but like it can get out of hand.
The two big things that I think this touches on is, one, should it be a federal decision or should you just leave it up to the states like it currently is? And then two, the point is, if you are a multifamily investor and you're going to get your financing options, the private lenders might be a little bit more appealing to you now if you don't have these regulations from a government sponsored entity. So the theory is, okay, if I'm a regional bank or something, or if I'm a local lender, I might be able to charge maybe a fee or a little bit more expensive of debt because I don't have these regulations that the government does, right? Because the landlord might not want to deal with some of those items.
Yeah. It's kind of interesting because I feel like this is the, most recent thing that we've talked about that seems to be like pushing the government away from mortgages a little bit more. Because last week we talked about the 40-year mortgages, right? And how those are going to be held in house by banks. And now we're talking about this, it's with larger multifamily stuff, but you're right. Like it will push people towards going to private lending institutions. I'm wondering, I'm like, is the government like secretly trying to get away from the mortgage industry a little bit because now they've locked in trillions of dollars in like 2% mortgages, right? And they've kind of shot themselves in the foot. And they also have all these institutional buyers bringing in trillions of dollars of money who are not going to be getting federal mortgages most likely because they're going to be just holding them on their books for yield. Because they look at things at like a macro level that none of us even have data.
Yeah, there's a reason why, like, there's like you're right, there's the unrest about like this is bullshit policy, whatever, for whatever your reasoning is, like the kind of whip effect. You're on the end of the whip and you're like, this is kind of crazy. But I do think you're right, at the macro level there could be a backing out of trying to unwind with some of the policies, right? Like the policy that was recently put in, or at least put out in front of vote or something like that, that you could refinance your mortgage with the existing interest rate you already have. So you can do a cash out refi and keep your current risk rate. So that, like, what that is that's trying to drive money into the system, trying to keep the real estate industry moving, right? But so you see all these different policies that are focused around like government subsidized loans. Why is what you should be asking, not like what.
Yeah. And what does that potentially mean? Because it would be interesting if, like, I don't know, that now I'm getting in, I don't want to say like the conspiracy range, sort of like
no, just understanding what's driving the macroeconomics, dude.
I'm hypothesizing. Yeah, I'm hypothesizing is like, is there a movement by the U.S. government to try and get away from the mortgage being one of the largest cruxes of their GDP?
Well, it definitely is like the linchpin of our American economy at this point.
It is totally. I mean, it's the number one wealth generation thing for most people.
I think
go for it.
No, it's again, I think there's a lot of the Blackstones or Vanguards are the people who are tapping on the shoulder of the people for these two, but they're kind of just looking at opportunity costs. If they locked in debt at 2 to 3%, and now they can buy their own debt at 5.5%, or even like sovereign debt at 5 or 6%. I just think when you multiply that by trillions of dollars, it's like, what is their opportunity cost of where they're going to put their money?
It's huge, right? Yeah. Yeah, I don't know. Like, I'm not sure what all it's going towards. It's just interesting to see these continuously coming up, like over and over and over again. Yeah.
It'll be interesting to see the stat that says like 48% of outstanding multifamily mortgages in Q1 of 2024. If we look at a year from now or 2 years from now, what that percentage is.
What percentage from 48 down to whatever. Yeah. I mean, I will say this personally. Like Mike and I, we operate in Washington, and honestly, most states have policy around like this. I think it's kind of odd from the mortgage perspective to manage like how you manage your tenants essentially. But like it doesn't affect how we operate at all. Like having all these tenant protections in place. Mike and I have always said this. Like, I do think that there's some risk when you have a very, very tenant friendly state like we have in Washington. counter that risk because you have to operate your business like a freaking business, and you have to understand. Do you think if BlackRock had to deal with this and we're managing tenants, that they would let a lease lapse over that time without initiating a rent increase? No, because somebody smart's going to be like, hey, we could increase our revenue by 3% if we just stop letting these things lapse and telling tenants in advance, right? And so I think personally, just the policy won't really affect it too much, but from the macro level with the larger conversation here, I think you're right. It will be interesting to see if that 48 goes down to 32.
Yeah. If you're buying a multifamily property and your operation, your deal is set on if these implications will make or break the deal, that's a bad case scenario that you're
totally.
Well, it's kind of weird though too, because like they're technically making their loans more risky. Yes. Honestly, like they should make it so that you can do whatever you want with the tenants. Like socially and ethically, that's not correct. But in terms of covering the debt, that would make it so that the loans are less likely to default.
Yep.
You know, but instead they're making it more difficult for the landlords and the owners.
Yeah, it's interesting.
Yeah, I don't know. Yeah, again, it's another one of those things that you need to keep an eye on, right? And like you said, Dylan, if you are getting into any of these larger assets and you are expecting to be able to do rent increases or anything with like a certain amount of speed, like you need to be aware of this. And, you know, I'm thinking about all these guys that we know that are like, I do multifamily properties in the Rust Belt or in southeastern states. If this was to go through, all that's going to change.
Yeah.
Like the whole part where you go in and you evict all 60 people in like that, you know, slummy brothel cracked in multifamily, you won't be able to do that anymore.
Yeah. It takes a little bit longer. Yeah.
Yeah. Which, I mean, in those kind of properties, that little bit longer can be hundreds of thousands of dollars in costs.
Totally. Especially the carrying cost or something like that.
Yeah. So,
it's interesting, guys.
Yeah. What'll be fascinating will be if this, trickles down to like residential stuff.
Right.
That'll be very, very different.
That's the thing. Like, are these things that they're implementing now, next year they're going to come out with something for 2 to 4 units and then something after that, so that's kind of like the precedent that I think people are kind of keep their eyes on. Like how far in the cookie jar are they going to put their hand?
Yeah.
Yeah, totally. I mean, the risk is like it sets precedents, and then you never peel back regulation. You always just add, and then eventually it goes to the Supreme Court, and they say whether it was valid or not. But either way, after 10 years, you lost money or whatever happened to you for that period of time. You can't make it back.
Yeah, very interesting. So cool. All right. Well, anything else to finish up?
I think that's it. And then we got a couple more topics ready for next week, but we'll touch on it then.
Awesome. Cool. Right on, guys. Well, thanks for listening. Please help us grow this show by sharing it with anybody who is interested in real estate or apparently macroeconomics, because that's what we freaking are good at. Or I would say good at. Is what we talk about now.
Yeah, we opine.
After Dan and I grab-assing for 2.5 years, here we are actually trying to make something of substance.
We are kind of smart. We just needed Dylan to let you guys know that.
I know we just need Dylan to let us know what to talk about, because I would say I would say that we generally kind of know. I don't know how to analyze things. It's just hard to know what exactly to analyze because, I mean, I don't know. I don't get my news from any sort of reliable source.
These aren't getting pulled from Reddit, Mike. So
Reddit and Wikipedia. That's Mike's.
Reddit's honestly pretty good.
In college, Mike was like citing sources. Reddit.
Yeah, I mean, I'm not gonna.
Mine is just ChatGPT.
ChatGPT. Shit, that's bad, I guess. So awesome. All right. Well, thanks for listening, everybody. We'll talk to you guys next week.